In this video, this is part 2 of the useful trading clues from the close. Stay tuned. Hey guys, warm welcome to you. So if you're here and you haven't seen part 1, definitely recommend you go back and look at part 1 because we talk about position of the close, range of the close, how useful that is. In this video, we're going to look at a couple of broad setups. We're not going to go really down into finite rules, and we're going to keep it broad for fading following price, basing that on the position and the range. So we talked about in the prior video the relevance of, I'm not going to go over the whole video, go and check it out, but for summary purposes we talked about the position. Where is the close relative to the day's range? Where is the close relative to the prior 3 or 4 days range? Where is the close relative to anything that's useful? Number 2, the range. In other words, the last 30 minutes, the last 60 minutes, the last 15, not so much, let's call it 30 and 60. What was the range? Was it a big range? And something that I forgot to add in that first video, which I'll add now, is what's the normal range for the close? In other words, go back and look at the closing period, whatever time you're looking at, the last 30 minutes, last 60 minutes, whatever it may be. Go back, look and say, okay, well, actually, we did 50 pips and we did 45 and we did 35 and we did 60. What's the average, or what's the, you don't have to take the average if you've got a really unusual one because it will skew the average. What's the most likely? What's the mode? You know, something like that. And then you can go, okay, well, a normal, in inverted commas, is 35 pips. That's what we expect, between 30 and 40 pips. Oh, we've had 100 pips or we've had 10 pips. Now we're referencing it based on a normal print, if you like. And so that can be useful. So the position of close is quite high. The last hour range was twice as much as normal. Clues, guys, clues. We need to look at these clues and go, this is telling us someone is shifting some volume here. And if they're shifting volume, do we want to jump behind them and ride that wave? Of course we do. This is what we're all trying to do as retail traders. We have the ability to be able to dip in and out and follow these guys and follow these patterns. Now, we all kind of try and look at big, broad pictures and charts and go, oh, that's so good and great. But in reality, it's little clues that give us the idea, because they're trying to hide. They're not trying to show everyone, hey, I've got a massive amount of orders I'm going to be buying over the next 4 days. Come and join me. Of course they're not. They're trying to hide stuff. But at some point, they still have to execute. So they might be trying to hide their orders, but they still have to do a deal. And if the supply demand, or if they are the demand, the supply is not there, they're still going to move price. So you can say that, well, they always hide their orders. Yes, if they can find someone to take the opposite side of it. If they can't, they still have to get the order done. And that's where we sometimes get the decent moves in price. So range relative to normal range. You know what normal means there. Okay, setups. So let's say, for example, now we have started to kick off. We have got a good range and the close, and we've got a good position at the high. And let's say we're talking about highs. So we're up here. We've had a decent kind of last 30-minute range, and we've been trending up during the day. So I'm just going to pinpoint this bit here because I'm going to rub this out in a second. Here, let's say that's our closing period. What can we deduce from that? Well, it didn't take much to say that's obviously a supply-demand imbalance in the favor of demand. We've had steady demand coming up here, and then it's accelerated into the close. So setup would be, okay, now in the next session, now if we're talking about currencies, that might be the next session, or if we're talking about equities, it will be the next day. Whatever it is, let's align ourselves long and let's think about how we could go long. Now, what we don't want to do, by circumstances we might want to, but what we don't really want to do is just go crazy and start pinging it at the high print there, because this thing, as we know, generally on a trend, we get a much sweeter risk reward ratio if we can buy a pullback. So whilst this is an okay trend, we can assume that if people have perceived this level as value, right, this is where we start really getting into some decent stuff here, and why we're better than anybody else out there. Because everyone's looking at this big trend and going, oh yes, well, I'm going to buy and pull back here and I'm going to do this, and they don't get it, they get frustration, they chase. We want to leverage on those guys because we know that this is the key here. There was some volume here, but most of the time the volume has come spiked in here. We know that they perceive that as value and they've bought right way up to there. So if we use that as our benchmark and say, well, if we assume that people were piling in here, then let's say the midpoint of this area here is a good place for us to at least start accumulating, because the assumption would be that if this demand is continuing, and by the way, we don't have 100% accuracy, of course not, but if we make that assumption, then we can start doing some buying here, and we can stop our buying here. And we can say, well, actually, you know what, if they perceive that as value, maybe that, whatever that range may be, you know, as long as it fits in my risk reward ratio, we can maybe pick up a little bit more here and then give that whatever our stop would be. So why are we being a little bit more aggressive with this than we would normally? And this is where we can kind of be winning, is that other people are saying, well, you know, we're gonna look for a pullback here, blah, blah, or we're gonna chase it up here. But we know that if that was a lot of range coming in the last hour, and again, we're looking at it now, assuming we've got our ducks lined up in a row here, then we can say, well, there's been institutional demand coming at that point, and there's been enough movement for us to suggest and hypothesize that that demand, or those price points there, are going to be price points where demand will continue. Yes, they might back off a little bit, which is why we get sometimes we get this edge, guys, is that they might back off in the overnight session. Let's assume it's equities for now. Let's assume it's S&P 500 futures driven up, and let's assume the overnight session, it starts to drift back off. Now, no one lobbing any size around is messing around overnight, generally speaking. You know, we've always got to take generalizations in trading, but assume then that price will just drift overnight. If we can tag a few buys coming in, what do we think is going to happen the next day? Well, most of the time, actually, what happens is overnight we get a drift lower, kind of early hours of the morning UK time, we drift lower. And then what normally happens is when Europe opens, this thing starts to follow DAX and FTSE, and we'll end up taking out the high. Sometimes I'll get an overnight trade on it. But even regardless of that, what do you think happens at the bell? At the bell, if the supply-demand imbalance is still there, these guys are going to be buying, and you get a continued follow-through, and that's when you're going to look to come out of the trade. Or if you've got a hypothesis of a 4 or 5 day move, you're going to get hold of that and move to a further trade. Okay, so very quickly, let's have a look at a follow type trade. So let's assume now that we don't have this. I'll rub this off for us. Let's assume that we don't have the trend. Okay, we have a position a close is here. The day's kind of done nothing. It's up a bit, it's down a bit. You know, we're here. The range of the close was relatively low. In other words, the last hour, let's say the last hour was that, right? So it's pretty low, pretty nondescript, non-committal. We had a bit of a demand, bit of supply, and we're closing in the middle of the point. So what does that do for us? Well, what it probably means is we don't want to be getting crazy, you know, trying to follow and breakouts, because evidence suggests that at the moment there isn't that supply-demand imbalance. So what do we do? So the next day, when we start seeing little spikes and little flurries up at the open, what are we going to do? Well, we're not going to follow those and look for breakouts. We're going to say, okay, this is where it comes back, actually, where we kind of mirror the two between the video of useful trading clues from the open, and go and check that out. Let's say the opening range is 50 pips normally, and I'll talk about that normalization. We've talked about normalization before. Let's say we open now a little bit of a gap. Let's be a bit realistic here. And then we start moving up kind of 40 pips here, and we're at highs. What do you think is going to happen? The likelihood is there's going to be not enough demand to squeeze us anymore. And let's say the first hour kind of prints here, right? So we're expecting a 50 pip range in the first hour. We've already got 40. What do you think will happen if we're hitting big levels and we don't have a supply-demand imbalance? Don't have a supply-demand imbalance, don't have a big level stopping things, and we're almost at the end of a likely range. We're 40 pips into a 50 pip range. What's the most likely scenario here? The most likely scenario is it runs out of puff and we come down, and not only we take out that low, but we do 10 pips below because we're expecting a 50 pip range. So now this is where it comes in with our, not our follow trade, that was the other one, that comes in with our fade trade. We're looking to fade moves up, and we're using the clues from the close to say, okay, no supply and demand imbalance, no real movement out of the range, pretty nondescript. How are we going to trade that? Well, we're going to stick with our mean reversion. Now, aligning ourselves with the broader trend still, so perhaps we don't want to fade pushes to highs if it's an uptrend. You know, if a slight, shallow uptrend, maybe we want to fade only pushes to lows, but you get the point. The point is, what we're definitely not doing is we're not following moves up and saying, okay, it's going to break out, it's broken out through the high, it's doing some business up here, it's up 40 pips already, it's above the Friday's high, we're all great. And you don't want that, because we haven't got that extreme supply demand imbalance and that momentum. We want to be fading that, or even better, just staying out. And if fade's not in our in our thesis, then just stay out of it. All right, guys, so that's just tip of the iceberg, really. You know, if you're interested in kind of find out more about this, then just hit the subscribe button and we'll have more videos coming out and loads more stuff coming up soon as well. If you like this kind of stuff, thumbs up is appreciated, as of course is your subscription, and the comments in the comment section below, any thoughts you've got on that. So useful trading clues from the close. See you next one. Take care. Bye-bye.